Another big story that we are following today, that we are tracking and building up to, is this. The South African Reserve Bank is expected to raise the repo rate to 4%. Its Monetary Policy Committee concludes its meeting today. Economists predict this won't be the only rate hike this year. So what does this mean for you and I as consumers? To tell us more, I am now joined by senior economist at PwC, Christie Viljoen. Christie, good afternoon. Good morning. Thank you for joining me. So a survey by Reuters of 23 economists has 18 of them expecting a 25 basis points increase in the repo rate. Why is this so unanimous? What are the factors that are leading economists to believe that this is the way things are going to go this afternoon?
Well, the Reserve Bank has been warning us since early last year that interest rates will have to eventually get back to where they were before COVID-19. And they took the first step in November with the first upward adjustment, and they continued with that warning. There's going to be lots of interest rate increases to come. Not a lot immediately. In other words, not going to be a big jump. It's going to be slow over time. But they made it very clear that in 2022, interest rates will probably be increasing 4 times, maybe 5 times, maybe even 6 times. So economists are basing their expectations on this. Also, we need to know that inflation is a bit elevated at this stage. It's towards the higher end of the Reserve Bank's target range. So those two elements are the key factors behind why so many economists are expecting the Reserve Bank to lift lending rates today.
Christie, we'll get to the story around inflation in a moment, but I'm intrigued by what you are saying. Is there perhaps a sense of course correction in that we are merely getting back to where we were in as far as interest rates are concerned at the point at which COVID-19 hit and we went into a lockdown? Because if we remember correctly, many of us were celebrating the decrease in interest rates, especially those of us with debt. Were celebrating that, but it was an intervention to help out the economy and struggling consumers at the time. Was it only a matter of time that we were always going to course correct and go back to where we were before?
Correct. So we saw in the first half of 2020, interest rates were cut by 3 percentage points very quickly, and that's a big cut. So the Reserve Bank at that stage took the position that this economy needs all the help that it can get. They knew that we were going to fall into recession. So they took this extraordinary step to cut interest rates down to, the repo rate was down to 3.5%. And we've always expected that we're going to get back to where we were previously, simply because South Africa generally has a higher interest rate compared to most developing economies, or developed economies, apologies. And we need to keep that relationship in order to make sure that our government bonds and also private company bonds are attractive as investment for foreign investors. So getting interest rates down to a level of 3 or 4%, it's not sustainable for South Africa in the long term. So that's why the Reserve Bank has made it very clear that it's temporary support, it's temporary accommodation, and they need to get us back eventually to where we were. Now, that's going to probably take about 2 or 3 years to happen, not going to be as quick as we had the decline in 2020. So this is probably more a case of getting back to where we were, or starting that process, and less of a concern on inflation specifically on the most recent numbers.
Add in then the factor of inflation for me, please, Christie. I always use the analogy of driving a manual car, that basically inflation and the repo rate, interest rates, is a bit like the clutch and the accelerator. When you push the one forward, you pull the one back, and vice versa. What in the inflation space has happened that has led us to where we are, where it seems inevitable that we will not only get one interest rate hike, but actually quite a number. I saw one study that talks about taking us all the way to about 5.25%, if I'm not mistaken, by next year or so.
Yes, so inflation is obviously the focus point of the Reserve Bank. They look forward at inflation, where they expect it is going to be, and then they determine their monetary policy by that. Now, we know the latest inflation number, 5.9% in December, is at that upper limit of the Reserve Bank's target range. But at the moment, and based on expectations and forecasts, it's only temporary that it's going to be that high. We're going to see it move back down towards the middle of that range during 2022. So I don't think there's a big concern at this stage that we're going to see 6% inflation for the rest of the year. So the Reserve Bank will obviously take into account the latest inflation data when they do all their assumptions and their forecasts, and then taking into account economic growth outlook, inflation, employment, and this drive to sort of normalize monetary policy after this extraordinary COVID-19 time. All of those factors will be on their mind this week as they speak about interest rates. And this afternoon, they're going to tell us what their view is on where they think the economy is going, where they think interest rates are going. And as we said in the beginning, most economists expecting we're going to see interest rates rise a little bit more, and probably the first of quite a few adjustments to come this year.
Lastly, Christie, what is the overall impact of all of this in a South Africa that's trying to dig itself out of the economic pit at the moment, where spending by consumers is not an insignificant factor if you are trying to get growth going. But if you have increases such as these taking out disposable income, it means, I don't know, you'll tell me, does it mean that, spending by consumers may be affected, especially if you factor in the other increases, including in the administered prices, such as the, municipal rates and levies, and also things such as oil, for example, and the oil price and fuel?
It is obviously a point of concern if we think about where this economy is going and the need to create jobs. The biggest part of our economy is consumer spending. So if there is more spending, we can expect more jobs to be created. And what you highlighted there is quite concerning when we think of more money going towards energy costs, electricity and fuel, for example. More money now would have to go towards repaying your debt. So it takes some money away from what households could spend on all kinds of activities and goods and services, whether it's food or television, whatever the products might be. So it's certainly an issue for us when we're trying to see how the South African consumer is going to recover from COVID-19. The Reserve Bank will tell you they need to get interest rates back to where they were. They'll tell you, and with real validity in that argument, the biggest challenges in South Africa are not linked to how high the interest rate is. We've got many structural issues, and probably number one is electricity load shedding. You can't fix that with interest rates. You can't fix the impact of load shedding on the economy. So interest rates are only a temporary support measure. And the Reserve Bank needs to stay prudent in its monetary policy work. It needs to look at this long term, and it needs to keep up with its mandate to focus on inflation, because most of the rate cuts that we've seen of late have been to support economic growth. They need to return their focus to inflation specifically.
All right, thank you for your time and your insights, Christie. I really appreciate it. Christie Viljoen is senior economist at PwC. So there you have it. Right now, all indicators are there will be an interest rate hike, a repo rate hike, when the Monetary Policy Committee of the Reserve Bank concludes its meeting a bit later on in the day. It's a bit of a pinch and a squeeze for those of us who have debt, but as Christie was telling us there, part of it has to do with course correction. The Reserve Bank had intervened to give reprieve and help out the economy when we went into lockdown, and that was not always going to last. The holiday is over, holiday, quote unquote. Of course, the flip side has to do with people who have investments and people who are living off retirement annuities and the likes, for whom the whole issue of interest rates is actually a good thing when they actually do go up a notch. It just helps them a little bit in terms of the returns on their investment. Still to come here on All Angles, we'll tell you this.